So one or two big risks. There are more than that, as you've heard from many of my competitors out there or my colleagues in the industry. The first thing is let's just acknowledge what's happened in the world, and I think Duncan took us through that in the first presentation. But really, we've had an unbelievable 18 months in markets. The fastest fall in the S&P 500, denoted by this red dot, falling 32% in a period of 5 weeks. Unprecedented response from central bankers, unprecedented response from fiscal policy makers, resulted in a 22-week recovery to the pre-COVID levels, and subsequently markets powering ahead to new highs. Interestingly enough, recently the United States National Bureau of Economic Research pronounced the 2020 recession in the US as all of 2 months. Who would have thought at the point in time where 13% unemployment sat in the United States? Of course, this has been an unbelievable time, and the uncertainty that has evolved, not just in economic terms, but overall in market terms. Where do we go next? And if anyone tells you that they know where the markets are going next, they're probably fooling themselves and, importantly, fooling you as investors. Central banks have been at the core of what we've seen in terms of this market recovery. Of course, we've heard earlier from various speakers around the riots that took place in July in South Africa. Driven initially by political type agendas, these political uprisings or public uprisings are really not unique to South Africa. We've seen it in Black Lives Matter in the United States as people really raise their voices around the inequality and the fact that they've been marginalized, not just from the economy, but in terms of participating in these extraordinary wealth-generating policies that central bankers around the world have gone through. Central bankers and policymakers are alive to this, and that's why the fiscal response was so enormous. The United States, in combination between the Federal Reserve and the government, are now sitting with a budget deficit of around 13%, a 10% increase in that deficit, as well as an expansion of the balance sheet that together mean that the US is sitting with a policy response equivalent to World War II. Of course, they're not alone. There's been responses in Europe as well. And South Africa naturally has come to the fore. Policymakers have put cash directly into consumers' hands. And through this recession, it's been the recession where retail sales have gone crazy and people have been spending their money trying to get ahead as they invest in stock markets. Uncertainty, and who would have thought? It's clearly a very different world that we sit in right now. Of course, these policymakers now and their seemingly shift leftward have opened the bottle and the genie is out. The reality is people are expecting to be supported by policymakers now. They want those cash checks back in their hands going forward. They want to participate in the economy and get theirs. This has resulted in this big shift left from governments around the world, and importantly, for the first time ever, we've seen central banks join the fray. Much more politicized than ever. Recently, the United States Federal Reserve changed its framework for the first time in a very long time to talk about not just price stability, circa inflation, but also full employment, which they previously had, but wanting full employment to be inclusive, focusing on the demographic differences that exist in their own country. Christine Lagarde's European Central Bank has followed suit, also talking about ensuring that inequality doesn't continue to the degrees that we've had in the past in that developed market. And most notably, I think we've seen an enormous shift over the last 12 months, not just over the last month, in terms of policy coming out of China, where President Xi Jinping has driven the agenda, not just around Marxist policies, but also specifically around social cohesion. And Duncan talked about the risk in terms of what that brings to Naspers and potentially the commodity cycle. Of course, his move towards social cohesion, everyone is frowning upon and saying, well, China's uninvestable. Funny. The US has also taken its own ammunition around social cohesion, talking about breaking up companies, changing the rules for companies like Huawei, changing the listing rules for Chinese companies listing in the US. These are not dissimilar to the policies that China is interacting, but the point being that policymakers are active. They have changed the rules of the game, and what we've seen over the last decade, and actually much longer, is likely not to work going forward. The uncertainty is real, and therefore, when we sit and think about the risks and designing portfolios and managing money, we have to be very alive to a range of outcomes. As we look at our menu of assets in my team, and we just highlighting that a short sort of grouping of assets here on a 5-year view, you can see very clearly that South African bonds stand out. And I would agree with Malungelu's view around South African yields offering a huge real return, which is not really available in the rest of the world. $16 trillion of negative nominal yielding bonds in the world, obviously a much higher degree in real terms. But South African bonds stand out as a juicy opportunity, certainly for South African investors. Of course, it comes with risks, and I won't go through those because they're well understood in terms of the fiscal dynamics, etc. But importantly, the one thing that really keeps me awake at night in terms of managing my clients' capital, managing my team in terms of the investment decisions that we're making, is really identifying a regulatory 28 portfolio. So a retirement portfolio for a South African investor that, based on our analysis, is only likely to deliver you around a 3% real return over the next 5 years. And that is pre-fees. And clearly, the big problem that we also have in the South African context, which Delphine talked about, is the concentration of our market in terms of the commodities, and ultimately the thing that keeps the South African economy going being capital flows from offshore and the global cycles. So how do we go about thinking about diversification? And importantly for us, when we think about diversification, we're trying to be really specific around the assets that we put in our portfolios. I'm showing you a chart here showing you the South African equity market in dollars relative or comparing it to the global emerging markets over the last sort of 15 years, also in dollars. South Africa is simply an extension of emerging markets. Those emerging markets are cyclically driven, and they're driven by capital flows around the world. So when you're buying South African equities, make no mistake, you're not betting on South Africa. You're betting on the cyclical aspects that are taking place, driving the world, driving the world's growth, driving the world's market. The next point I'd like to make is same chart in terms of unpacking this, but the dark shaded portion of this chart is exactly what I showed earlier. The dollar returns for the South African equity market over a period of time, completely stagnant. The lighter grey shaded bars is the rand return. So the combination is the rand return, and you'll see that on the right-hand axis as you look at that. That's the Aussie return for SA equity investors. It didn't go anywhere for about 5 years until this recent post-COVID event where we pushed to new highs. But the red line is the US dollar ZAR exchange rate. So when you're betting on the SA equity market, you're betting on that global cycle, and you're betting on the continuation of a weakening rand. Let's be very clear around what diversification is and understanding what the bets are that we're putting in a portfolio and playing for specific payoffs and variant perception. When I look at South Africa and I look at the equity markets valuations, and we started talking about this in 2017, we said that we felt that the South African equity market was fairly overvalued. Many of our peers in the industry were saying historic PEs in South Africa would be at around 15, 16 times earnings. Our contention at the time was no. It should be trading at around 8 to 9 times multiples because the growth rate in South Africa is declining so very quickly. And I think Delphine talked about that earlier. But importantly, the return on equity in South Africa has fallen dramatically since 1995 and now sits at around 10.5%, depending on the time horizon that you look at. So growth rate's falling, return on equity or return on invested capital is falling, and it's clearly understood why that would be the case given the dynamics that we have in South Africa. But a falling return on equity and a rising cost of capital, our bond yields going up, means that it's very difficult to really generate profitability. So in South Africa, ROEs at 10.5%, yields at around about 9.5% to 10%, difficult to really be profitable. And therefore, as a foreign investor, what is the point of being in SA? Of course, Malu made the argument about the commodity cycle, and I would agree with Malu in terms of that upside. The reality, though, is not just China that's going to be buying commodities. The Biden plan and the European recovery program is talking about another $5 trillion coming to market over the next few years. And of course, let's not lose sight of the fact that Cyril is talking a better game. We are focusing on this energy liberalization. We are focusing on public-private partnerships. And so one may make the very small case that perhaps there are green shoots in terms of the reformist policy. So what can we do when we're faced with all these uncertainties around what might happen in a world as we design portfolios? So the first thing, we like hedges. We are very, very clear in our thinking that we don't know what's going to happen next. But if we can try and skew our portfolio for positive outcomes, we're going to be better off for a range of different scenarios. Scenarios, again, Delphine talked about. So the first thing we think about is when we look at that mix of assets, that short mix of assets that I showed you earlier in terms of returns, we said, well, you know, those returns are not looking like a dripping roast. But when you look at them risk versus reward, if you look at the risk spectrum denoted by volatility, you'll notice that there's a high degree of clustering. So what can we do to reduce that clustering and improve the diversification of these assets that we'll use to build a portfolio? And it's our view that if we go about doing some currency hedging, forget about the amount that we'd recognize, we do two things to the portfolio. The first is we actually create the dispersion between these assets from a volatility or risk perspective. The second thing we do is we actually lift the returns because we are harvesting the carry, the interest rate differential between South African rates and US rates as an example. So we've lifted the return profile of the portfolio and individual assets, we've shifted the volatility to the left, and we've actually given ourselves a higher degree of diversification in the portfolio. And importantly, we're betting on the things we want to bet on, not just the rand, which overwhelms these assets in terms of a volatility perspective. The next thing we think about in terms of potentially hedging our portfolio, and we think that this high correlation to emerging markets needs to be very carefully monitored. And so while we have a high correlation to emerging markets and we predispose to the cycle thinking it will continue, we want to be exposed to it. We know the market's a little bit expensive. We highlighted that in terms of that falling ROE. The ZAR volatility might dominate returns, but let's be very clear that insurance is needed during this period of uncertainty. So what are we going to go and do? Well, let's go and participate in these structural reforms. Let's go and participate in that cyclical market. Let's go and look for volatility, hedges. Let's go and look for options in the market that will protect our portfolio. I'm giving you two examples here. The first is buying an option structure for a period of 6 months, which would cost about 4% for every 1 million rands of equity exposure that you're looking to protect. So around about 40,000 rand per 1 million. Because we play in the derivative market fairly carefully and we look through the term structure of volatility, and at this point in time, we've looked at it and we've said, actually, we'd rather buy protection out for 12 months against 17 or 18% fall in markets. It will only cost us an additional 25 basis points to ensure our total South African equity exposure, 1.45% over a 12-month period. That allows us to participate if these reformist agendas come through. It allows us to participate if the commodity cycle takes hold. It allows us to participate in the cyclical upswing of the global economy and the stimulus that continues to take place. Then finally, because of our predisposition to South African bonds, clearly we need to be aware of this inflation narrative. It's not our base case that inflation will be taking place. But we try and find something that's going to help us hedge our portfolios, but at the same time pay us to hold those assets. And for that, we want to hold global financial assets or banks more specifically. The consumers coming out of lockdown, the consumers going to enjoy the normalization in inverted commas in a post-COVID world, if there is ever a post-COVID world. And they will be re-leveraging. Policymakers said to banks that they cannot actually go and pay dividends and do buybacks, so they were over-provisioned, expecting a massive massive credit cycle during the COVID period. Moody's indicated that they thought that the credit default experience would be around 14 to 15%, the highest on record. That didn't materialize in any way. And so we had a very limited credit cycle as furloughs were extended, if you think about all those policy points that I made earlier. Of course, now buybacks and dividends can be extended. Companies are going back and buying, or banks are going back and buying back their own stock and increasingly paying out dividends. That's happening in the US, it's happening in Europe, even happening in South Africa. So for us, it's an interesting position to hold in a portfolio at a point in time where everyone's worried about inflation. If inflation was to take place, you should get a steepening of bond curves, and banks should make more money, given the fact that they borrow short and lend long and improve their profitability. And importantly, if interest rates were to go up, which is not our base case again, in the short term, these banks should perform materially better as rates rise. And so that acts as a positive carry hedge for our portfolios. So in short, returns are challenging. It's a hell of an uncertain period of time. South Africa is a unique case, but what's happening on the ground is not reflective of our South African equity markets or indeed our asset markets. I've given you 3 quick solutions to potentially think differently around how you construct a portfolio for a variety of outcomes, and I would agree with Duncan's final statement around independent thinking and differentiated thinking in this brave new world. Thank you.